All right, let's go to my panel. Joining me here in studio is Ian King, a senior research analyst at the financial information provider Banyan Hill Publishing, and Bolt business host Julia Sun. Thank you both for being with us.
Yeah, thank you for having us.
So, Ian, U.S. markets are shrugging off this trade battle today. Now, you could argue that most of this has already been baked in with some of the volatility that we've seen. But we do have the biggest investors of our time, the likes of Warren Buffett, Paul Tudor Jones, Lloyd Blankfein. They don't seem too concerned about this. They figure that this is all going to sort itself out, that ultimately cooler heads will prevail because both the U.S. and China have too much to lose. What do you think?
Sure, I tend to agree with them. I would also note that Ray Dalio, the founder of Bridgewater, tweeted today that the trade war with China has begun. And both of these countries, the United States and China, are coming at this from positions of strength. China's exports as a percent of GDP are down 50% in the last 10 years. The United States economy is strongest it's been in the last 10 years. So both economies are coming at this from positions of strength, and it looks like the leaders are ready to ramp up the rhetoric and potentially ramp up the tariffs.
Julia, they are both coming from relatively strong positions, as Ian says. But if you look at the trade surplus, this is focusing on $34 billion worth of goods. The big picture, though, is China shipping around $505 billion worth of goods to the U.S. last year. Compare that with around $130 billion that the U.S. ships to China. So it stands to reason on that front,
yes, and
that China has more to lose if it continues this way.
Yes, and you hit a very, very important point. This $34 billion is not equal to that $34 billion because, you know, we have a deficit. And I would argue, like Ian said, both countries has a lot to lose. And earlier you heard Dan said that what's on their list, the number one is soybean and then pork and then some other incidental items. But I would argue soybeans are a very important item in the U.S. export profile because last year, $14 billion worth of soybean were imported to that part of the world, China in particular. And that's a huge amount. And think about it, where are the soybean growers? They come from, you know, agriculture-heavy states in the Midwest, right. Indiana, Minnesota, Iowa, and Nebraska. And ironically, they were the ones who voted Trump in.
Well, it's no coincidence, Ian. You can say that China is targeting exports that come from Republican states, from red states, knowing that that's going to lead to political pressure on the president. And President Trump and the Republicans, they have to worry about election cycles, something that China's President Xi Jinping does not. He doesn't even have to worry about term limits anymore. So China's playing the long game here, and the U.S. has to cater to more shorter-term concerns. Does that put China at an advantage then?
Sure. I think China is targeting commodities because that's what they import. I don't think it's a political move. I don't think it's faced towards red states. I think that's what China imports, excuse me, and so that's what they're targeting. On the flip side, the real issue here is excess savings of Chinese consumers. China has one of the highest savings rates in the world. Because of that, they have to export more goods to foreign countries. The United States is a big trading partner with China. We've had this structural issue going on now since China joined the WTO. There are a couple ways that you can liberalize these flows of U.S. dollars to China. One of them is tariffs. The other one is increasing consumption in China. So how do we figure out ways where Chinese citizens can buy more goods around the world and lower their savings rate?
Well, that's one of the issues in the broader picture, Julia, and that is China's practice with regards to foreign companies, particularly U.S. companies, and the forced transfer of technology, the forced transfer of data. Now, whilst these tariffs don't particularly hit at that is part of a bigger theme and a bigger picture here. And the concern is if we're only putting tariffs on products, China's going to run out of ammunition because, as we said, of the trade deficit. Is there concern that China's now going to start to take this out on U.S. companies trying to do business there?
I think so. I think so, because if you look at the grand scheme of things, I definitely think they have a longer list of potential action items than we do. Let's say there are a lot of companies, U.S. companies, that have already a pretty solid presence in that part of the world. McDonald's, Procter & Gamble, Apple, Walmart, just to name a few. And let's, for example, say one of them wants to open a little store. Then what do you need? You need permits. You need a lot of signatures. And their government can easily stop the paperwork process. It doesn't cost them anything, but we and our companies would be royally screwed.
But at the same time, China is trying to promote itself as a global business leader, as a destination for foreign investment. So you could argue that that could be cutting its nose to spite its face. And Ian, in the meantime, we are seeing the Shanghai Composite take a big hit. It is down. It's in bear market territory. It's down, if you look at the chart, over 22% for the year, and it's continuing to go down. Is that an indication of anything to you? Do you think that shows some kind of investor concern on the Chinese side?
Well, obviously, China has more to lose than the United States in a trade war. It could be mutual assured destruction in the end of it. The one leverage that China holds over the United States is they own $1.2 trillion in U.S. Treasuries. At a time when the United States is running a fiscal deficit of about $1 trillion in 2019, we're going to need to sell more debt, and we need to find somebody who's going to buy our debt. So it's important that we maintain a strong relationship with China. But if China decides to sell the Treasuries, like you said, they're cutting off the nose to spite the face because they're selling something that they own and causing the price to go down.
Well, I mean, yeah, that's still a long way off if they go that route. But, Julia, the president's been saying, look, I didn't start this war, but I am fighting back. He's been addressing these egregious discrepancies that he says he doesn't understand how China and these countries got away with it for so long. Does he really have an alternative but to do this? Because if he says, okay, forget it, are we not just kicking the can down the road? And ultimately, that is going to damage America in the long term.
Well, I would argue in a way he did start this trade war because today is the first day.
But this is in retaliation, as the president says, to a buildup of unfair practices and tariffs and steel dumping and intellectual property theft and trade disparities. So he's saying that it's just about time that someone fights back a little.
Well, I would argue, maybe I don't necessarily agree with Yen on that. I think China, of course, has a lot to lose, but I think we have almost equal amount of, in terms of dollars or anything else, intangibles, to lose as well. Because once we start this quote-unquote trade war and all these tariff then the average Johnson, Joes, and Madisons are going to flip the bill for this, right? Like, look at what's already on our list.
But that's the short-term picture. I mean, Ian, very quickly, is this a question of short-term pain for long-term gain?
Well, 25% tariffs on $50 billion of Chinese goods amounts to about $12.5 billion in tax. We just got a $200 billion tax cut for corporations and individuals. So in the long game, the grand scheme of things, this is very marginal compared to the fiscal stimulus we're looking at right now.
All right, Ian, thank you. Stick around. We want to chat to you a little bit later. Julia, appreciate you being with us. Thank you so much.
Thank you.